Mr. Market, friend or foe? Imagine waking up one morning to find that you have a business partner named Mr. Market. Every day, Mr. Market offers to buy your shares or sell you his at wildly different prices. Some days his offers seem generous. Other days, they seem downright foolish. How would you deal with such an unpredictable partner? Stay with us, and in the next few minutes, we'll reveal how you can turn Mr. Market's erratic behavior to your advantage, ensuring your path to financial success. Welcome to Nouveau Riche Investor. Today we delve into the fascinating concept of Mr. Market, introduced by Benjamin Graham in The Intelligent Investor. We'll uncover why understanding Mr. Market is crucial for your financial well-being and how you can leverage his fluctuations to achieve long-term success. Benjamin Graham, often called the father of value investing, introduced the allegory of Mr. Market to illustrate the stock market's irrational behavior. Mr. Market is your business partner, but unlike any partner you've ever had. He shows up every day with different prices for your shares, influenced by his mood swings of fear and greed. So, what makes Mr. Market so important? It's his unpredictability and irrationality. He's driven by emotion, not logic, often offering prices that don't reflect the true value of the underlying businesses. Your task as an intelligent investor is to understand and take advantage of his erratic behavior. Graham's concept of Mr. Market teaches us the crucial difference between market price and intrinsic value. The market price is what Mr. Market offers you on any given day, while the intrinsic value is the true worth of the business, determined by its fundamentals. As an intelligent investor, your goal is to buy when Mr. Market's price is below the intrinsic value and sell when it's above. This requires a thorough analysis of a company's fundamentals and a long-term perspective, rather than reacting impulsively to market trends. To make informed decisions, Graham emphasized the importance of discipline and patience. This means sticking to your investment strategy, even when Mr. Market's erratic offers tempt you to act otherwise. Here are some key principles to remember when dealing with Mr. Market. Conduct thorough analysis. Evaluate a company's financial health, earnings stability, and management quality. Focus on intrinsic value. Understand the true worth of the business and ignore Mr. Market's emotional swings. Maintain discipline. Stick to your investment strategy and avoid reacting to short-term market fluctuations. Exercise patience. Be willing to hold on to your investments until their intrinsic value is recognized. Many successful investors, including Warren Buffett, have mastered the art of dealing with Mr. Market. Buffett's disciplined approach and focus on intrinsic value have made him one of the most successful investors of all time. The journey to becoming an intelligent investor is marked by understanding and leveraging Mr. Market's behavior. It's about building wealth steadily over the long term, rather than chasing quick profits. This requires discipline and the ability to stay the course during market downturns. In conclusion, Mr. Market can be both a friend and a foe. By understanding his behavior and focusing on intrinsic value, you can turn his erratic offers to your advantage. Follow these timeless principles, and you'll build a robust portfolio that stands the test of time. For a deeper dive into these principles, I highly recommend reading The Intelligent Investor